But now's the best time to prepare for what's to come and to protect your businesses from potential risks. There's certainly been a lot happening in the world of insolvency since the start of COVID, or COVID's first declaration back in March of last year. And it's often said that it's hard for SMEs to keep up to date with legal changes and be properly prepared for the future. So we put together a panel of industry experts to talk about the current state of play, to share some practical advice with you today, and to help you move forward through what is still uncharted territories. Now, joining us today, or leading the discussion today, is Samantha Goddard from STG Legal, and Samantha is the Managing Director of STG. She specialises in helping SMEs to recover debts quickly, to boost their cash flow and reduce losses from bad debts. So welcome, Sam. We're also joined by Lee Crosswaite, and Lee is a partner at Worrell Solvency and Forensic Accountants. He's a registered liquidator as well. So he brings the heavy boots in today. Thank you, Lee. Lee is expert in providing advice to SMEs around administrations, and he leads the liquidation investigations, the asset recovery, public examinations, and litigation where that's required. We're also joined by Craig Mason from SMS Law, and Craig is the Legal Practice Director. His experience is in the area of litigation and dispute resolution and corporate insolvency. So we've definitely got some people on our panel today that can help us answer all of the questions that we might have for ourselves, for our customers, or for others. What Samantha, Lee and Craig are going to cover today would be the current state of play, as I mentioned, and what's changed for SMEs, pardon me, in the space where they're trying to recover an account, industry insights and some case studies from Lee, and he'll also cover the indicators of insolvency and how to be prepared. You will absolutely have lots of time to ask questions. As they come up, I'd ask you to hold them to the end, but if you'd like to pop them in the chat box as we go along, we'll gather those questions to raise at the end. Remember that all material that we chat about here today shouldn't be considered legal advice, but general comments on the state of play. And all of the experts that are joining us today are willing to have some time with you if you need to have a conversation about a special situation and the best action for you. So this is all general information today. I think we'll jump straight into it. And first, I wanted to share some stats and facts that Creditor Watch have shared, and that's around the current state of play. We are in somewhat of a strange environment. COVID lockdowns are hitting Aussie businesses pretty hard, and some are having to stop trade or halt trade. Others are in a bit of a holding pattern while they work out what can happen in the future. What we're seeing is, for the first time in the past 12 months or during this COVID change, is some shifts in the way that people do business. And that would be things like trade receivables. So for the month of August, trade receivables around Australia dropped by 12.5%. That means we're doing less business. We did less business in August than we had in preceding months. In another sign that business activity is slowed, credit inquiries are down 19% from July and a full 5% on the same time last year. But this is the first negative result that we've had since September of last year. People do credit inquiries when they're making a decision about whether or not somebody's credit worthy. So that downturn in trade receivables is reflected in the number of credit reports people are doing. August was an interesting month for credit defaults as well. So for the first time during this COVID period, credit defaults have increased by just over 0.6% in August compared to the same time last year. Now, that's an incredibly small increase, but it is the first increase that we've had since May 2020. So again, things are starting to shift a little bit. What we're seeing, and our experts will cover why we're seeing it in terms of moratoriums and things, but we're seeing fewer court actions being commenced, and the drop in court actions is almost 60% since COVID was first announced. Now, the main reason for that is that the ATO and banks are not currently pursuing debts. They've set in place their own extended payment arrangements and moratoriums. So they're not pursuing debts. They certainly could, but they're not doing it just yet. There are people struggling through trade lockdowns. They're unable to trade at all, and for many, those cash reserves are dwindling. What I did note was that the chief economist, Harley Dale, said that we're in quite an artificial economy. Credit defaults were steady in 2021, and external administration, so insolvencies, fell heavily over July and August, but that's likely to reverse as we get back into a more natural environment. Through information that feeds through to Creditor Watch from sources such as their subscriber account aged receivables or aged trial balances, as well as Xero reports, they're able to predict the industries that are going to be most likely to fall over. And I want to share that information with you now. So these are the sectors that are going to have the highest probability of default in the coming months. We see accommodation and food services at the bottom there. There's no surprises given the state of play right now that accommodation and food services are the riskiest space for businesses to be in. Transport, postal and warehousing are the next riskiest spaces to be in, to be operational in. And we had a thought about that, given that we're all at home and we're all shopping online. Why would that be? Potentially it's because we have some state issues, so cross-border issues. It could be that we can't find the people to take on those roles at the moment. And it's definitely probably to do with a lot of red tape to get border passes and the like, to get people travelling and get the country moving. Administration and support services is around a lot of services that have been brought in-house, which is more around saving jobs for other people. Information, media and telecommunications ties in with newspapers. And then we have professional, scientific and technical services. I think most people would be concerned about that construction space. It's already considered quite a high risk area. But construction, as you can see, the lighter grey line there was June 20, the darker grey line, July 2021. There hasn't been too much change in what's happening in the construction. It's still mid-range risk, but far behind accommodation and food services. So I hope that gives a bit of an overview as to where we are right now. What I wanted to do was have Samantha and Craig give us a bit of an overview of what has changed for creditors when they were trying to recover debt. This is something that's going to be more important as we head into 2022, absolutely. So I'll hand over to Samantha and Craig right now.
Great, thanks Angela. That was a great state of play and some interesting stats there about what's happening. So as you said, what is it that's changed recently when you're trying to recover a debt? So we expect changes have occurred. Things are different in the world, different in Australia, different in Queensland, different in different states. So as expected, things have changed. Some are as a result of actual law changes that have been brought about by the government, whilst others are essentially just byproducts of what is happening in Australia and around the world. So one of the things that's changed is that payment terms are being pushed out. So the time taken between issuing an invoice and payment has increased during the COVID times, and that's across most industries. And that's due to uncertainty. People would or businesses are keeping the money in their bank account rather than paying it out to their supplier, for instance. And there's also the flow-on effect of they're getting paid slower, therefore they're paying other people slower as well. So unfortunately, payment terms are being pushed out, but need to be aware of it. And as always, I think communication about that is imperative. So you're aware that if they do want to change from 30 days to 45 days, at least you're aware of that and can talk to them about it. So payment terms being pushed out. Sam, what about the legislation changes for minimum thresholds? You're on mute, Sam. Sam. Having some technical difficulties there, Sam. We can't actually hear you, still on mute. But everything you said was great.
I'm there now.
Okay.
I think I did not unmute myself. Sorry, everybody. Technically challenged this one right here. I might just go back. I was mentioning, just in addition to what Craig was mentioning about payment terms, particularly I found very interesting a recent update in the public sector. So in public administration sector, which wasn't on the table that Angela shared, payment terms are around 35 days in that, well, last time I checked, in that area, which is odd where government sectors are supposed to be paying SMEs in that 14-day period to assist their cash flow. But from the 1st of October, there is an important change to the payment times procurement connected policy. So this means that hopefully we'll see cash flow for small business contractors in the Commonwealth government sector, or Commonwealth government as a whole, improve. So, you know, we know that faster payment times will improve small business, and support is crucial for small business at this time. So I thought that was just an important factor to mention in addition to what Craig was saying. But on the specific law changes for the minimum thresholds with creditor statutory demands and bankruptcy notices, they have permanently increased from $4,000 to $10,000 permanently. So essentially those thresholds have doubled from the pre-pandemic thresholds of $2,000 and $5,000, which we saw during the pandemic at $20,000 and payment of being allowed 6 months for payment. So the rationale behind this is to lessen the threat of actions that could otherwise push viable but distressed businesses into insolvency over small debts. So that rationale has continued after those temporary mechanisms were in place. During the pandemic, we also saw temporary safe harbour for directors from personal liability from insolvent trading, which is now no longer on the table. So we might just go back over to you, Craig, just about why, or what we're seeing with court actions and why they're down at this period of time.
Yeah, absolutely. So in every state but Western Australia, legal recovery action for the purposes of recovering a debt is down. So as Angela mentioned in the stats, the ATO and banks, for instance, aren't taking any action. And there's also a lot of other companies that aren't taking action either. That's due to they might have debtors in Victoria and New South Wales with the current lockdowns not proceeding there, and that's been generally the attitude since whenever it was June last year, that proceedings, particularly in lockdown areas, aren't happening. So that's brought the amount of proceedings down quite a lot, and generally small businesses are worried about other things and aren't taking that legal action to recover the debt. So it's a variety of reasons. I think everyone was sort of in a bit of a holding pattern last year, and now it's starting to pick up more, but it's still down this time in 2019, which is essentially the stats that you should be referring to. So yeah, legal recovery action is down, and that goes with what you said as well, Sam, with the minimum threshold. So bankruptcy notices and creditors petitions were also not happening either, and starting to happen more with the increases. And I think it's probably a good idea that it's stayed at that 4 and 10. I think that's probably the middle ground that a lot of people have been calling for a while. So I think that's one good thing that's come out of the changes. So we mentioned the ATO and the banks. Sam, what's their approach at the moment?
So their approach, as Angela briefly touched upon before, is they're taking this slow moratorium period and they're also having that conciliatory approach with creditors. So they're allowing extended payment arrangements, and they're not pursuing or enforcing their debts at this current time. So I think it's important to note that the ATO and the banks are really Australia's largest creditors, generating the majority of debt in Australia. So because they are not pursuing their debt, that's why we're seeing court actions down. And because they're not pursuing their debts as well, we're kind of going through this lull period where, whilst they're not taking action, it's just a matter of time until they do start to, I believe, start to enforce those debts. And that's when we're going to start to see some more insolvencies. But another big change, which you might want to touch upon, Craig, is the small business simplified debt restructuring that's commenced.
Yeah, absolutely. So this was introduced by the government, and Lee, who's waiting there patiently for his part, will no doubt touch on it as well. But in order to be a small business to be eligible, you've got to have debts of less than $1 million. No person that's a director of that company or been a director of that company for the 12 months before the appointment has been involved in a small business restructuring or the simplified liquidation process in the past. That's preceding 7 years. So it's obviously going to be legislation for some time. And in order to appoint a restructuring practitioner, this is the big one, the company must have paid all the entitlements of employees that are due and payable, and given the returns, notices, statements, applications, etc., to the tax office. So lodged all your documents. So what it does say is that you need to have filed all of those, not necessarily have paid the tax debts. You do have to have paid the employee entitlements to be eligible for that. So it's something that's new, hasn't really been taken up, and Lee will touch on that. But it is something that's out there. And if you do appoint that small business restructuring practitioner, then there's moratoriums on actions from creditors during that period of time. So important to be aware of. And I think we just got the call from Beck that the time's up. So back to you, or Angela.
Yeah.
Can I just mention one thing on that I think is very interesting and important for everyone to know, is that during that moratorium period, a creditor also holding a personal guarantee from a company's director is also precluded from pursuing it during that moratorium period. Just an extra catch that I think people should be aware of.
Yeah, so it's quite a powerful change, definitely.
Yeah.
Thank you, Sam. Thank you, Craig. One thing I wanted to add just quickly is that the ATO, as the biggest creditor, as Samantha said, does not report to credit bureaus around companies or directors who have debts. And that would be an important thing for creditors to be aware of. As I understand it, and they've been talking about it for about 2 years, the time is approaching when the ATO will be reporting to the credit bureaus, so Creditor Watch, Equifax and Ilion, to name a few, will have information feeding through from the ATO about debts that are outstanding, which would help creditors make more informed decisions. All right, we'll pass over to Lee now. Lee, let's have a chat about indicators of insolvency. As a creditor, how would you know if somebody's going through rough times and might be a higher risk?
Thank you, Angela. It's the case that often when you're chasing debtors and things like that, you're going to see some signs come through that a debtor is in some financial difficulty. Some of that may be down to the fact they have genuine difficulty. There may be issues in their supply chain or own payments if they're a contractor or subcontractors and the like. So that's where a number of factors you'll often see that may raise some flags with you. Up on the screen there is one of the leading cases of ASIC employment. Now that's back in 2003, but really this is the benchmark of what the courts will see when they're assessing a company's solvency or any business and the like. A few of those will be not visible if you're the creditor that's trying to pursue debts. Other ones will be red flags straight away in your face, depending on what information you may have available to you. It depends whether you're perhaps a secure creditor like a bank who has a lot of visibility over a debtor's finances, or it may be if you're just a trade supplier supplying a small amount of goods or services, you may not have the full extent of this other than perhaps the credit bureaus and the like that Angela had just said. So just running through a few of those, there's 14 in total. And there's a lot of practical application of these. I am very limited on my time today, so we'll just run through them briefly and I'll point out those that sort of will be more obvious. The 1 and 2 up on the screen, continuing losses and liquidity ratios. Often they'll be the ones that will be seen on the company's financial statements and the like. Again, depending on the status of the creditor or the contracts that they're dealing with, they may or may not be visible to the creditor pursuing their debt. In those amounts, what we're looking for is historic, where there's losses year upon year, where there's losses made. That's often an issue that flows on with cash flow. The same with the liquidity ratios. That's where you're comparing assets and liabilities, the resources and obligations of the company. And if they're starting to deteriorate over time, then that's quite an obvious one. So when the company is dealing with the banks, these are the types of things that they're looking on. Some contracts we also see, it may be that they require subcontractors to provide financials to show that they got the wherewithal to be able to complete contracts, so that some of these might be visible from that. Number 3 is a big and obvious one that Angela's just spoken some time on in regards to tax debts. From an insolvency practitioner, I can tell you almost every appointment that I get made to a company or an individual has a tax debt of some sort. Usually they can be quite substantial given the or comparative to their turnover. So that is often a red flag. And now if the reporting through the credit bureaus comes through, and I think from memory they're looking at parameters somewhere around debts of 100,000 or more, then they're going to show up and need to be explained from the creditor's point of view. Another one in a similar vein is poor relationships with banks. If they're struggling to adhere to their payments, they might be getting friction or pressure from banks to deal with debts. One interesting one is going to be moving forward is the accumulated tax debts that we're seeing pop up on a lot of balance sheets across the country. Given that the tax office hasn't really pursued any debts from any great amount for the last 18 months or so since the start of COVID. So the banks are going to have to be able to deal with that. So that'll be interesting to see in a bit of watch this space. And that will flow on to when companies' finances come up for renewal, or if they're looking to extend further and borrow more funds, then there may be some issues with that. So that's going to be an area that could be interesting. So if creditors are watching what is happening, if they're checking if there's other PPSR registrations against the customer or things like that, then that's something to keep an eye on.
Lee, just quickly, factoring used to be a bit of a dirty word. That's changed for a lot of businesses now. Is that such a warning sign now as it used to be, as people use invoice financing as an alternative?
Often it's the case, but it can be a case-by-case basis, in the sense that if you've got some industries such as the construction one you've spoken of, or mining, where you've got long payment terms, like 60, 90 days plus, sometimes, and those subcontractors who are supplying labour that need to pay weekly wages, for example, then sometimes factoring or an overdraft facility is something that's almost essential to them. So, but if you've got a customer who hasn't previously been debtor factoring and then suddenly they start using that facility and really relying upon it, then yes, that can certainly be an indicator.
Great, thank you.
I'll move back. Sorry, Angela, just 2 final ones on that prior slide, which are, I think, very noteworthy. Probably skip down to number 7, is supplier requiring cash on delivery terms, or they're stocking supply. This is a very big one. and particularly where you're a creditor and that particular customer perhaps not, obviously it has their terms extended, they've got a debt accruing. If they stop ordering from you, but then you see that they're starting to deal with other suppliers in the industry or alike, then that one can certainly, so if they're shopping around, or you've had to put them on COD because simply their debts are extending but not getting paid. So that's a big flag if you have to get to that resort.
And watch out for the big orders that are out of character.
Correct, that's right, yeah. Moving to the next slide, please. And again, this flows on, creditors out of trading terms. So if they start to push the terms, you know, if they're historically a very good payer, paying within sort of a 30 or 35 day terms for those, but then suddenly they start to drift out to, you know, 50, 60 days or something like that, then certainly that's a big flag, particularly for credit managers. The next couple, the case related to 2003, so they specifically were identifying checks, but I've added in their EFT and direct debits, which are more common now. And that's where, you know, payments are failing, whether there's a payment, EFTs that are not clearing, or there's direct debit arrangements. If they're starting to get dishonoured, then those types of are more flags to keep an eye out. Then if it gets to the point of special arrangements, so if you're having to have tough discussions with those customers and they say, oh, okay, look, I can't afford to pay my balance now, but I'll pay you, you know, $1,000 a week or a fortnight, or I'm expecting some big payments to come from a special project that's been delayed or something, and then those that you're allowing different terms, then that is something to definitely keep an eye about, particularly if you're getting rounded amounts, which sort of flows through to number 13 down there. And probably the final one I want to make on this point is if it gets to the resort where there's letters of demand, there's court actions, there's judgments being made against that customer, those types of activities, then again, that with the other that I've mentioned before, a lot of those are really the big red flags that you're going to see that you need to keep an eye on if you're a creditor of those clients. So I thought then it would be beneficial just to move on to the different insolvency types. Now, some of the listeners will already be aware of some of these, but I think it's worth just touching base as to what you might see a customer happening, and suddenly you're getting notices from an insolvency practitioner like myself about an appointment to a customer of yours. And this is relevant because whilst there hasn't been a lot of creditor-specific pressure coming through, the government has been making moves and the ATO as well, in terms of having directors of companies in particular, or business owners, deal with the affairs of their business if they're having difficulties or if they're insolvent. Now, a company, by definition of the Corporations Act, or an individual under the Bankruptcy Act, is considered insolvent if it can't pay its debts as and when they fall due. So that means that they have resources such as cash at bank or debtor collections available to pay the outstanding debts as they fall due. So if there's a large accrued tax debt that's not under a payment arrangement or something like that, and the company hasn't set aside those GST monies or alike, then you know that means they're probably looking at an insolvent position. So therefore, they may be looking at one of these insolvency appointments. Or it may be that the creditors themselves, such as what we're discussing, is pushing for payment, and that may lead to statutory demands and winding up by the courts. And there's two sides to it. There's the voluntary appointment side or the creditor side, and within those, there's also different subcategories, I guess, as well. The first two on the voluntary column there, voluntary administration and a small debt restructure. So they're the provisions in the corporation that are designed for directors to put their hand up and say, hey, look, we've got some issues. We do, though, think the business is viable going forward. We need some assistance and we need some compromise or relief from creditors to be able to push that through. So a voluntary administration process, in essence, is designed probably for your larger entities, and the small business debt restructure, which came into play on the 1st of January of this year, is sort of designed for small businesses, as Craig and Sam discussed, probably with a large outstanding tax debt, but perhaps not many other creditors, and in particular, all employees and superannuations paid up to date. Or the directors of the company might decide that there's no future for the company itself, and they just have to close the business and move on. So that's where you're looking at 3 and 4 on the left-hand column: liquidation and simplified liquidation. So that's a liquidation where a liquidator is appointed. Their job is basically to collect and sell any assets, conduct investigations into the conduct of the company, generate a pool of funds, and hopefully be able to distribute a dividend to the employees and the other creditors. Just on the right-hand side, on the creditor-initiated, court liquidation is essentially that same process as I've just explained, but it's initiated by a creditor taking court proceedings to wind up, as opposed to the directors voluntarily putting their hand up. You've got receivership, which is basically the banks. They appoint a receiver to come in and enforce their security. Again, their primary role is basically to recover whatever can be recovered for their appointer. I'll just move down now onto the personal bankruptcy side of things, because this is also relevant. Again, you've got voluntary or creditor initiated. Bankruptcy itself, if the individual decides to put their hand up, that's called a debtor's petition. Or if it's a creditor that has to go through the court process, that's a creditor's petition. Once the bankruptcy commenced, essentially it's the same process. Again, it's for someone to take control of the individual's assets, do some investigations, sell off any assets for a pool of funds, and then distribute those to the creditors. Alternatively, an individual may wish to look at doing what's called a personal insolvency agreement, which is under Part 10 of the Bankruptcy Act, or if it's a consumer type sort of debt, an accumulation of credit cards, then you might have a debt agreement under Part 9 of the Bankruptcy Act. Those are where, again, similar to voluntary administration or a small debt restructure, that's where the individual's looking for some relief, and also then to compromise with the creditors to be able to still pay them something, but to move on and be able to proceed with their life and perhaps a further business if they are able to do that. So it's important just to be aware that those types of appointments may be popping up, and more so as the tax office and or creditors start to get in the swing of things and start to push things along a bit further over the next 6 to 12 months.
Lee, can I put you in a difficult position? Can you do a bit of crystal balling? We've got this strange artificial environment that we're in right now. We've seen, if you believe or can understand the ABS stats, we've had a 4% increase in the number of businesses that have been started in the past 12 months. But what are you seeing coming down the pipeline? Is it the case that there are a lot of insolvent businesses that haven't been shaken out yet? What's your prediction?
I think there is. We have to keep in mind there's still quite a lot of the government's COVID stimulus floating in the economy, and that's still making its way through the system, so to speak. In addition to that, a lot of creditors were put on hold from March through till December last year, being able to pursue their debts with any real pace, as Sam and Craig had gone over. So there hasn't been a real push. Also, the ATO and the banks, neither of those, who really are the big drivers in a lot of the small business, they haven't taken any action for a long period of time. And to be perfectly honest, I don't think that we're going to see much action out of them this year, and probably even the first quarter of next year as well. There are other factors such as federal elections and things like that that certainly do play into how they deal with the debts that they need to recover. And as I said before, construction industry, as we discussed before, there's a lot of stimulus put into that, into new home building and other things like that. So that has pushed forward, but then you've got other factors such as rising materials, delays in supply and things like that. So I think as those drag on further, then that perhaps will come through in the months ahead.
As a debt collector, I understand your position. Not everybody's happy with the liquidator.
Yes.
But when it's a court-appointed liquidation and you're trying to act in the best interests of the creditors, what's your approach there in terms of communication and styles? We have to chase a lot of creditors. We fell a forest in terms of the amount of paper that comes through. Potentially this is going to get busier. How do you do it? How do you do it differently?
Okay, well, look, to be honest, whether it's a court appointment or a voluntary appointment, we're there to act for the creditors and deal with the company's affairs. So at Worrells, we've got a portal where people can log on, they can register their claim within the liquidation, they can view on-time recoveries up to date in terms of what our costs are, and also download the reports and the like that they need to do. So I think the important thing for creditors is to make sure when they first get appointed that you get in contact with the liquidator, you lodge all the documents that relate to your debt. So if you're a supplier, you've got your outstanding invoices. If you've got any credit terms and conditions in terms of PPS registrations or equitable charging clauses or other things like that, that you provide all that information up front so the liquidator can deal with it straight away, and that we're put on notice that we need to have a look at that as well. So that's it. And then as time goes on, every liquidation requires a liquidator to issue a report within 3 months, which outlines broadly what position of the company is, what are the dividend prospects, and what sort of investigations they have or proposing to undertake. So certainly there's a fair bit of work that gets done in that first 3 months. And then after that, I think there's for the creditors to then, if they've got further queries, to follow up with those with the liquidator.
Quite an emotional time for perhaps the directors who are going through the process. I don't imagine everybody is cooperative.
It depends. Certainly there's a contingent that are uncooperative, that we have difficulty getting any information out of, and sometimes requires ASIC intervention to help out. But a lot of the time we find the directors that they know something's coming, or they're even just relieved to be able to for something to be dealt with, the troubles that they're having. So it depends on the individual and the individual circumstances, and that's part of our role, is to basically identify the best method to liaise with them and to obtain what we need.
Very good. All right, thanks, Lee. We might hand over to Samantha and Craig right now to help us be good scouts and be prepared for 2022 and beyond. Sam and Craig, over to you.
Thanks, Angela. Thanks, Lee. That was really insightful information. And I think that we can all really agree that there's many things that are not in our control during this climate. We don't know when the ATO and the banks will start ramping up their enforcement action. So I think it's probably really good to focus on what you can do. And there are a number of things that you can do right now. We would, strongly suggest don't sit in your hands at this point of time. What can you do to put yourself first and get your debt paid as a matter of priority during this period of time? So prevention is better than the cure. And this is preventing bad debt altogether, as opposed to providing credit and then chasing it after the fact. So that by far is the main rationale behind what you can be doing now. And now we'll move on to what you actually can do. So I'll move on to you, Craig, as what's one of the number one things that businesses can do right now?
Yeah, thanks, Sam. So it's crucial at the moment when you're going to deal with someone that you've got all the information in front of you, so you can make an informed decision about whether or not you want to work with that particular business. So it's always crucial, but even more so now. So who is it that you're dealing with? And the way to find out that information is to get some form of credit report, credit check. When you're looking at your credit report, you need to look at cross directorships. So what other directors might be involved in other companies? As we've mentioned a few times, are there any court actions, particularly work cover or any of those sorts of entities, dips in payment times, any other credit inquiries, and has there been any changes recently to registered office, the directors, some form of structure, because that can mean sometimes that something's happening in the background. The company mightn't be operating as best as they can be. So get all that information. You need that knowledge in order to make a decision about whether or not they're the right business to work with before you start potentially providing them, goods on credit, for instance. So definitely need to be doing your credit checks before you make those decisions. But Sam, then we've got the big one is T's and C's.
Absolutely. And I think that, that the part that Craig was talking about is that engagement process. So before you're starting work with a new customer or a new client, making sure that you're doing those checks. But when you do start doing work or start providing goods, terms and conditions are crucial. So, you need to put your business in the best position possible. Should a customer not pay for those goods and services or raise a dispute? So those terms and conditions can be by way of a credit application. And I know that many businesses will have a credit application. Alternatively, a quote with terms and conditions attached, which you're getting acceptance from your customers or clients before you commence work. That's crucial. It's not really good enough to provide a tax invoice attaching your terms and conditions after the fact. There needs to be an agreement before you extend credit. And I can see that Ben has asked a question which goes directly into these terms and conditions and a few of the examples of those terms and conditions. So securing a position with terms and conditions such as a cost recovery clause, being able to recover costs if you need to engage a debt collector or enforce legal proceedings, an interest clause, being able to charge interest on any overdue debts, a jurisdiction clause, a clause whereby you're indicating the state in which the laws will apply to your terms and conditions and the agreement. A force majeure clause, which will essentially kind of put the agreement or the terms and conditions on a pause or a hold if there's things out of your control that affect you from being able to carry out the terms and conditions or supply goods and services, which then continue on once that event, for example, a pandemic, weather event, something like that, finishes and you're able to continue with the contract. Retention of title clauses and security under the PPSR. They're crucial to make sure that you can either get the goods back or get paid first, essentially. And then to Ben's question about the wet signature as opposed to electronic signatures, we're certainly at the moment, I'm sure Craig is as well, recommending that terms and conditions include electronic transmission of documents and electronic signatures, because that's the world we live in now. We're not in the same room together to sign agreements now, and we're getting agreements via email, using electronic signatures, things like that. So it's not really necessarily what the one is better than the other. I think it's really just making sure that your terms and conditions cover that electronic signature and the electronic transmission of documents is agreed by the parties. So that's another term and condition that we would use. Did you want to mention anything on that, Craig?
Yeah, I guess it flows into the other point as well about personal guarantees when it comes to wet signatures as well. You probably do want that to be witnessed by someone, so that's where it can become, better to have a actual signature on your personal guarantees. So that forms part of the terms and conditions as well. So we would have all heard of it. We mentioned it before about the moratorium. It's important to have the personal guarantee always, but even more so now. So as we know, property prices are going up. People are buying properties left, right, and centre. So the way to protect you if a debt is outstanding is to have that personal guarantee, and the person's assets are now going up. So that's a good thing if you've got a personal guarantee. So it's important to have that as part of your documents. That's the T's and C's. In terms of Beck's question there about what happens if they won't agree to your terms and conditions, I'll go back to the point that I raised about doing your credit checks. That's where you find out the information. If you send your credit application to someone with your terms and conditions and the response is, I'm not signing that, for instance, then you've kind of got an indication potentially as to how they foresee the relationship occurring, and they may not want to sign it, for instance, because they don't want to agree to it because they have thoughts in their mind that maybe they won't pay or won't comply with the agreement. So they're the sorts of things you take into account to make that informed decision about whether or not you want to do business with that person if they won't agree. You can change certain conditions. We don't recommend that, but always seek the advice. Sometimes you might see terms and conditions come back with some changes made on it with initialed as sort of a sneaky way of doing it, and you just got to be aware of that when you're looking at the documents that come back as part of your credit policy, that you're checking to make sure there's no changes made to the T's and C's. So Sam, I think that's all I had for.
Definitely, Craig, and I think it's just there, that risk assessment, having the terms and conditions there to begin with. If you don't think your terms and conditions are where they need to be, we would recommend that you get them reviewed. And then those amended terms and conditions ought to be or should be forwarded to your customers and clients with a cover letter indicating that terms and conditions have now been amended, and documents should be signed for future goods and services to be provided. So, now is the time to be looking at your terms and conditions and getting advice on them. And sorry, Angela?
I know when I receive a nice little fat little booklet at about 3 font from my bank about my credit card, somewhere in there it often tells me that at my next purchase I've agreed to all of the terms and conditions that they've amended. Is that what you're talking about in terms of acceptance or notice? Could it be as simple as at your next purchase these new terms apply?
Yeah, absolutely. But, I think even more watertight or more best practice is getting that agreement from customers as well to say, thanks, noted, received your terms and conditions, agree, rather than, just forwarding it and then in that terms and conditions and indicating that from your next order. That would be sufficient, but I always like best practice, always like everything kind of crossing the T's, dotting the I's.
We've each mentioned the PPSR, so the Personal Property Securities Register and the associated acts. Can we cover that a little bit more in terms of how people can protect their assets, and including the assets of, say the item as it becomes something else? Now, I'm thinking for some of our clients who are online today who are representing people who make things. So Dean's online today. His clients or his members are in that sort of cabinetry and furniture making space. So their skills, their wood, their products go into other items. How can they secure themselves?
Again, it's having the correct terms and conditions that if those goods or services, are intermingled or become a different product, to making sure that the client has or is able to have or hold that on trust essentially, and then they secure their interest by not only having the terms and conditions but by also registering it on the PPSR. I think it's really important to note that it's not having the terms and conditions gets you only halfway there. You do also need to register, and it's very, very cheap to register your interest on the register itself. So if you're concerned in any way, getting your terms and conditions checked, so having all of the terms and conditions for retention of title until the goods are paid for in full, if they're intermingled or change in any way, making sure that they're all. Did you want to mention anything on that, Craig? Do you have anything else to add?
Oh no, I mean, yeah, it just goes back to if you don't have it in there, then you're not going to be able to rely on it.
Exactly.
I think with terms and conditions, you just get the full armory, and you may not use any of it. But if you don't have it there, then you can never use it. So we always say have it in there, particularly with PPSR. I mean, if you don't have it as part of the T's and C's to form that security agreement, then too late.
Having it in there as well, but also registering as well. I recall having a question from a client recently as to whether or not the client will accept those terms and conditions. Some people have those terms and conditions crossed out, and those terms won't be accepted. Again, it is the agreement of the parties and your risk appetite as to whether or not you want to afford credit to that particular business who's not willing to agree to your terms and conditions of trade, and not willing to back themselves as well. Like if they're crossing out terms and conditions, just be dubious, and that should be an alarm bell for you.
Thanks, guys. That was great. There's an opportunity for us all to ask some questions. So let's put Lee and Craig and Sam in the hot seat. We do have Gita wanting to talk about e-invoicing as the ticket to early payment from the government. What do you think about e-invoicing and the pressure it might bring on businesses to arrange priorities of payments? Might be a good one for Lee as our accountant.
Look, I certainly think, I mean, all technology assists. And so as long as you're getting the invoices there, front of mind, obviously with the backing of terms and conditions or whatever priorities are required, then it's not going to hurt at all. And I think it assists in two ways. One, obviously, there's a tracking element to it as well, so you can prove delivery and etc. like that if you need to enforce, rather than the old, I never got the invoice type sort of things. And then secondly as well, again, as I said, depending on how it's being delivered, or even if you're using some of the accounting programs like Xero and others to invoice as well, there's other follow-up functions and other things that can be utilised too from that.
I think the kicker for that one in the fine print is that it always has to be a compliant invoice. So no little mistakes in there to hold things up. We do have a question that's come through, and this might be a good one for you, Sam. With the changes to the statutory demands and bankruptcy notice costs, is that fair to creditors to make it more expensive and harder to get paid?
That's a really interesting question, and I might just start off with the answer to that being that I was a little bit frustrated when it changed, because there was a few clients that I had that were ready to kind of pounce on that creditor statutory demand of bankruptcy notice when the time came, and then the increases happened. But I was also very happy to see that the bankruptcy notice didn't increase to 20,000 or like it was in that temporary stage. I think what's important to note as well is this whole process with the creditor's statutory demand and bankruptcy notice, and then if you proceed with the wind-up application or the creditor's petition, is that your costs of those processes are paid in priority. That is if the company is essentially wound up or the person is essentially declared bankrupt. Your costs of that process are paid in priority to the liquidator's fees, and all other debts from then on. Your unsecured debt, though, that you're chasing by that process is then goes to compete with other creditors. But I suppose it's the incentive then for creditors to start that process if they know that potentially they will get their costs paid. Yes, it is a very expensive process, but it is very important to make a commercial decision, you know, as to whether or not it's the correct process for your particular debt. If it's a $5,000 or $10,000 debt, wouldn't be recommending that you proceed down that action. But if it's, you know, the debt's over $20,000 or more, you'd certainly be looking at that process as a way of potentially getting paid first.
Awesome. All right, thank you. A couple of times throughout the presentation, you guys have touched on your supplier channels, and Craig talked about making sure that you do credit checks. I think you should do credit checks on your suppliers as well to make sure that you're going to be able to deliver the goods and services that you want to be able to deliver. We don't appear to have any more questions at this time. So what we wanted to do is share some resources with you that are complementary. So from Craig and Samantha as our legal eagles, they're happy to review your terms and conditions as they stand and make some recommendations if they need them as to how they could be more secure without being scary. And if you'd like to arrange that, please email me and I'll facilitate that for you. Lee has provided to us the Worrell's Guide to Insolvency, which is a great handbook that explains all of the things that you need to be aware of as a creditor or even somebody considering heading down that insolvency path as to what you might need to know, as well as some easy to read and understand case studies. Lee has also provided the Worrell's Solvency Checklist, which is a great self-assessment tool for businesses to see if they might need to be or in a position where they need to get some expert help. Something that came to our attention today was from Beyond Blue. You know, we are all in very unusual times right now, and life's often quite hard without the added pressures of a pandemic, but we find ourselves in that place. So business owners are being offered the opportunity to go through a coaching program through Beyond Blue to get support. It's called New Access, and that will be support in terms of a health check for your business and some coaching, as well as some personal support there. So we think that that's an important thing to share, and you might want to share that on with other people as well. So thank you all for participating today. And if there's anything else that we can do for you, please don't hesitate to contact me, Samantha, Craig, or Lee. Thank you.
Thanks, everyone.